Hello, bosses, and welcome back to Boss Economics World, the only show on the internet that tells you how the global economic sausage gets made, and why it usually tastes like last week's leftovers. It's September 16th, 2025, and the air in Washington, D.C. is thick with the smell of pumpkin spice lattes, political desperation, and, is that a rate cut? That's right, folks. The prodigal son of monetary policy, President Donald Trump, has descended from his weekend retreat to bless us with his economic forecast. He's predicting a big cut from the Federal Reserve this week. It's perfect for cutting, he says. And who are we to argue with perfection? The stage is set for a showdown at the Eccles Building. In one corner, we have Fed Chair Jerome Powell, a man who has spent the last 9 months holding interest rates steady like a nervous intern carrying a tray of hot coffee. In the other corner, we have a slowing labor market, inflation that's as stubborn as a mule in a mudslide, and the small, insignificant matter of the President of the United States publicly calling for your resignation for months on end. The market, in its infinite wisdom, has already priced in a 93 to 96% chance of a 25 basis point cut. A quarter-point snip. A little trim off the top. But the president wants a big cut. This isn't just a policy meeting, my friends. This is a high-stakes game of chicken, played with the world's largest economy as the prize. So, grab your popcorn, because today we're diving deep into the beautiful, chaotic, and utterly absurd theater of American monetary policy. First, let's talk about the official justification for this little rate-cutting party, the slowing labor market. It's a narrative that's being pushed hard, a sob story designed to tug at the heartstrings of even the most hawkish of Fed governors. And on the surface, the numbers look, well, they look. The August jobs report was a real page-turner. The economy added a whopping 22,000 jobs. No, you didn't mishear me. 22,000. That's not a typo. To put that in perspective, that's about the number of people who decide to start a podcast in any given hour. It's a rounding error in a country of 330 million people. And get this, the report also quietly revised June's numbers to show the first net job loss since the dark days of 2020. But wait, there's more. The unemployment rate ticked up to 4.3%, the highest it's been since 2021. And if you look under the hood of this jalopy of a jobs report, the engine is sputtering. The number of people employed part-time has hit its highest level since March 2018, with 17.8% of the workforce now in part-time roles. The number of people working part-time for economic reasons, that's the polite term for I'd rather have a full-time job but this is all I can get, is sitting at a cool 4.7 million. The labor force participation rate has been sliding all year, and the racial unemployment gap is widening, with the rate for black Americans at 7.5% compared to 3.7% for white Americans. So, the labor market is weak, right? Case closed. Time to open the monetary spigots and let the good times flow. Not so fast, my astute viewers. This is Boss Economics World. We don't just read the headlines, we read the fine print. And the fine print tells a fascinating story of self-inflicted wounds. Where, oh where, could this slowdown be coming from? Could it possibly have anything to do with the administration's flagship economic policy, a trade war waged via tweet and tariff? The Yale Budget Lab estimates that the 2025 tariffs are projected to slash U.S. real GDP growth and lead to a decline of about 505,000 jobs this year alone. Manufacturing employment is down 78,000 over the year. Wholesale trade is shedding jobs. It's almost as if making it more expensive for businesses to buy things and sell things is bad for business. Shocking, I know. And let's not forget the wage picture. Yes, nominal wages are up 3.7% over the past year. But what about real wages? After you account for the little pest we call inflation, real average hourly earnings for all employees actually decreased by 0.1% in August. Since January 2021, consumer prices have risen 22.7%, while average hourly earnings have only gone up 21.8%, meaning the average worker's purchasing power has actually fallen. So, the Fed is being told to cut rates to save a labor market that is being actively kneecapped by the very administration demanding the cuts. It's like a firefighter being told to turn up the gas on the blaze he's trying to put out. It's a policy paradox wrapped in a political enigma, served with a side of economic absurdity. Now, let's turn to the other side of the Fed's famous dual mandate, stable prices. The official target is 2% inflation. And where are we? The latest CPI data for August shows inflation hitting 2.9%, the highest since January. Core CPI, which strips out the noisy food and energy prices, is even stickier at 3.1%. So, with inflation running nearly a full percentage point above target, the natural, textbook response would be to cut interest rates? Welcome to 2025, where the textbooks have been thrown out the window and set on fire in the parking lot. The official line from the rate cut cheerleaders is that this inflation is just a temporary blip, a fleeting mirage caused by those pesky tariffs. They argue the Fed should just look through it. It's the economic equivalent of closing your eyes and wishing the monster in the closet would go away. But let's look at what's actually happening to prices. This isn't some abstract number. This is hitting real people in their wallets. The August CPI report is a horror story for the American consumer. The index for meats, poultry, fish, and eggs is up 5.6% over the last year. Non-alcoholic beverages are up 4.6%. Used cars and trucks? Up 6%. Airline fares jumped 5.9% in a single month. And it's not just the big-ticket items. Prices for apparel, furniture, and even tomatoes are on the rise. And where is this coming from? Surprise, surprise, it's the tariffs. After months of companies absorbing the costs and burning through pre-tariff inventories, the dam is finally breaking. Footwear companies are raising wholesale prices by 5 to 10% as their inventories run out. Home Depot, Macy's, Nikon, they're all passing the costs on. Researchers estimate that the average effective tariff rate is now the highest it's been since 1935, costing the average household the equivalent of a $2,400 income loss. So, the administration's trade policy is directly fueling inflation, pushing prices higher for everyday Americans. And the proposed solution? Cut interest rates, which is like throwing gasoline on the inflationary fire. This isn't just looking through inflation, it's actively inviting more of it. This creates a toxic economic cocktail known as stagflation, slowing growth combined with rising prices. It's the worst of both worlds, a situation that haunted the 1970s and gave nightmares to a generation of central bankers. And we're walking right into it, with the president holding the door open and waving us in. This brings us to the heart of the matter, the real story behind the headlines. This isn't just about a 25 basis point cut. This is about the future of the Federal Reserve itself. This is about a hostile takeover of the last bastion of economic sanity in Washington. The concept of central bank independence isn't just some academic theory. It's a hard-won lesson from centuries of economic crises. When politicians control the money printer, they tend to use it for short-term political gain, leading to hyperinflation, currency collapse, and economic misery. Think of Turkey, think of Argentina. The 1951 Treasury Fed Accord formally established the Fed's independence in the United States, creating a firewall between the political whims of the White House and the critical task of managing the nation's money supply. That firewall is now under a full frontal assault. President Trump has been relentlessly pressuring Jerome Powell, a man he himself appointed, to slash rates. He's publicly mused about firing him, a move of questionable legality that sent shivers down the spine of global markets. He's even tried to remove another Fed governor, Lisa Cook, from the board. This isn't just needling, as some reports gently put it. This is a systematic campaign to dismantle one of the core pillars of American economic stability. And now, with Powell's term ending in May 2026, the succession battle has begun. Trump has graciously given us a short list of his top 3 candidates to take the Iron Throne of monetary policy. Let's meet the contenders, shall we? First up, we have Kevin Hassett, the White House economic advisor. Hassett has been playing a very interesting game. Publicly, he's a staunch defender of Fed independence. He recently said on national television that monetary policy needs to be fully independent of political influence, including from President Trump. He even warned that countries that let leaders take over their central banks find it's a recipe for inflation and misery for consumers. Strong words. But, and there's always a but, Hassett has also been critical of the Fed's political missteps, like not cutting rates sooner. He's seen as having a dovish stance that aligns with Trump's agenda. So, is he a true believer in independence, or is he just saying the right things to get through the confirmation hearing? It's a classic case of watch what they do, not what they say. Next, we have Christopher Waller, a current Fed governor. Waller is the academic of the group, a monetary theory guy from the St. Louis Federal. He's seen as a pragmatist, a non-ideological policymaker who shifts with the data. He was a dove in 2019, arguing against rate hikes when inflation was low. He turned into a hawk in 2022, advocating for aggressive hikes to fight inflation. And now, he's one of the governors who has been voting for rate cuts. Recently, he's even suggested that the inflationary impact of tariffs might be temporary and can be looked through by the Fed, a view that conveniently aligns with the White House's position. Waller represents the intellectual capitulation of the Fed, providing a sophisticated, data-driven veneer to a politically motivated policy. And finally, the most fascinating and perhaps most alarming candidate, Kevin Warsh. A former Fed governor, Warsh is the ghost of crises past and the prophet of a radical future. He is calling for nothing less than a regime change at the Federal. He argues that the Fed's hesitancy to cut rates is a mark against them. Warsh's vision is a dramatic departure from the post-1951 consensus. He has openly called for a new Treasury Fed Accord, suggesting much closer coordination between the central bank and the fiscal authorities. This would effectively tear down that firewall of independence and subordinate monetary policy to the borrowing needs of the government. He dismisses the inflationary impact of tariffs as a one-off change in prices and argues that if it turns into sustained inflation, it's the Fed's fault for not cutting rates aggressively enough. Think about that logic. If the government punches a hole in the boat, with tariffs, it's the Fed's job to bail faster, by cutting rates, not to tell the government to stop punching holes. Warsh, once considered a hawk, has completely pivoted to an aggressive pro-rate cut stance that perfectly mirrors the president's demands. He is, in essence, auditioning for the role of the ultimate loyalist, a Fed chair who will not just bend to political pressure, but who will actively embrace it as a new policy paradigm. So here we are, on the eve of a pivotal decision. The Fed will almost certainly cut by 25 basis points. It's the path of least resistance, a small sacrifice to appease the political gods without completely shredding their remaining credibility. Powell will likely deliver a carefully worded statement, emphasizing data dependence and trying to signal that this isn't the start of a big cut cycle. But make no mistake, the damage is already done. The Overton window of what is considered acceptable pressure on the Fed has been shattered. The very idea of an independent central bank is now a partisan issue. Gold's recent surge suggests that smart money is already hedging against the long-term risk of a politicized Fed and the potential for a weaker dollar and higher inflation that comes with it. For you, the bosses of your own financial destiny, this is a time for extreme vigilance. The market may cheer a rate cut in the short term. Historically, rate cuts near market highs have been bullish. But the long-term institutional rot is a five-alarm fire. A Fed that prioritizes political expediency over price stability is a Fed that will eventually lose control. The drama unfolding this week is more than just economics. It's a battle for the soul of American economic institutions. Will the Fed maintain its wobbly independence, or will it become just another tool in the political toolbox? The answer will determine the economic landscape for years to come. Stay sharp, stay informed, and as always, stay ahead of the herd. This is Boss Economics World, signing off.